Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes.
Hi, welcome to the Holistic Accountant. Today we wanted to talk about when you should really sort of consider superannuation as a tax saving measure. You know, we're coming up to tax planning season, and we typically recommend for a lot of clients to contribute into super to maximize their contributions and obviously the associated tax deduction with the contribution. But most recently, I met with some clients who were in their sort of early 30s who run quite a successful business. They're on track to make about a $1.5 million profit this year, which is great. They've worked hard, they've kicked some goals, and they've got good, strong cash flow, but they hadn't invested any personally outside the business. So they've got no personal assets, or their only cash flow and only source of income is basically the business itself. So as their holistic accountants, we weighed up whether we should actually contribute into super and whether it's a good strategy. And I thought this will be a great podcast to talk about what our considerations are when determining whether we should be making a contribution or not.
So let me start by talking about some of the benefits of contributing to super, because as a financial advisor, you would think that I would be aggressively positive about it. Of course, there are some significant tax benefits. If we make a concessional contribution, now a concessional contribution is a contribution into super that we will claim a personal tax deduction for, and the concessional cap, there's an annual cap each year, is $30,000. That includes, so if you pay yourself a wage, you'll have to pay superannuation guarantee, that's the 12% on that salary. That is included in that $30,000 cap. But most of our clients don't pay themselves wages. They'll just take drawings and dividends at the end of the year. So that gives us flexibility on making the maximum concessional contributions in their own personal name. Now, those contributions, that's a tax deduction to you personally. When they go into super, they're taxed at 15%. So you're not going to not pay any tax, but you're paying at 15% versus, if you are in the highest marginal tax bracket, you're going to save, more than 30% tax by making those super contributions. So they are very tax effective in terms of a tax saving mechanism.
Now, there's obviously compounding benefits with making those contributions over those years, and they can't be ignored. The earlier you contribute, the more money you're going to have in retirement, obviously, if you're in a good super fund and so forth. So even modest contributions in your 30s and 40s can snowball and have a significant sort of effect or asset base for you in retirement. So it can't really be ignored. But, in this particular case for these clients, they had already been making modest contributions as part of their salary. This is more so referring to contributions in addition to their salary.
Also, we've got to think about surplus cash flow. When we've spoken about this before in this podcast, when we start a family, if we're going to do that, or go and buy a forever home, quite often there are periods of time where we're going to have less surplus cash flow, just because obviously expenses are higher and sometimes family income is lower, particularly during starting a family. So before we get to that stage, when we're younger, sometimes we can have more surplus cash flow. So in our 30s and potentially 40s as well, before we hit into private school fees, huge mortgage or spending more money on travel, those sorts of things. And so if we do have that surplus cash flow, it can be a great sort of savings mechanism in terms of putting it into super, remembering that there are annual caps. So it's going to be difficult. We can catch up on unused contributions, which Ben will talk about in a second. But if we don't contribute it for many, many years, we'll never get those caps back. So contributing something at the beginning is better than nothing.
Now, what the catch-up contributions are is if your total super balance is under $500,000, you can carry forward caps that you haven't used for the last 5 years. So hypothetically, if, I hadn't contributed we're in 24-25 now, so if I hadn't contributed in the 2019-20 year, my full cap, I can use the balance of that cap in this year and claim a tax deduction for it. So it allows one-off contributions in years that, for example, that you might have a great income year. So, think of a year where you might have a large CGT event, you've sold some shares or sold a property, it's a great time to actually use those contributions to lower your tax rate.
The final thing to think about is contribution splitting, which means you can move your contributions into your spouse's account, 85%, so the after-tax amount. And that would be really worthwhile if you have wildly unbalanced super. So, for example, if I had a lot of super and my spouse had very little super, what you want to try and do is keep those balances relatively even so that you're able to remain under the transfer balance cap, which is the tax-free amount. Now, we know what that is today. It's $2 million, but that could change over time. Of course, I'm absolutely certain the government is going to mess around with it. So you put yourself in the most advantageous situation by making sure your balances are relatively even. So if you're making contributions and one person has a lot less super, maybe contribution splitting into that person's account is the best thing to do. And you just do that at the end of the financial year.
All right, so maybe we'll talk about some of the reasons why we won't consider superannuation strategy as a tax-saving measure. So obviously super is quite liquid. And when I say liquid, it means that you can't access it until you're, 65 now, I believe, Stuart, and meet the conditions of release. So it means that you've got money locked away for a significant amount of time. And if you need to access those funds earlier for, the forever home, as Stuart mentioned, children's education, or, investing further in your business, it could really hamstring you in terms of doing that. So sometimes we won't consider doing that superannuation contribution strategy if you haven't met your goals.
The other thing to think about, as Mena said, you can't access super until 65 or 60 if you're permanently retired from the workforce. The other thing to think about then is the opportunity cost of using those monies. And probably the biggest opportunity cost is property. Because often we need a deposit for property, we need to make some sort of contribution, or we need the ability to have the highest or the most amount of income in our personal name to service debt and prove borrowing capacity and so forth. And so that can be the biggest opportunity cost I find when working with clients. And one of the bigger considerations that we think about is that if you haven't already got a foothold in the property market, then contributing or locking money up into super for another few decades isn't probably a massive priority.
So I think here a balanced approach works best. And I think working with your holistic accountant, you should model scenarios that can help you clarify the trade-offs between sort of contributing into super, repaying debt, investing in elsewhere. That's where sort of your holistic accountant as well as your financial advisor should work together to determine what the most appropriate approach is. And like we mentioned before, I don't think it's zero super, but it doesn't necessarily need to mean 100% goes to super. It's definitely a balanced approach dependent on your personal goals and lifestyle.
Yeah, I think you'd have a plan, Mena. So it could be, I could actually make friends with zero super for a finite period of time. So we might sit with the client and say, let's not make any super contributions for the next 2 years, remembering that we can always use those catch-up contributions in later years. And our goal might be, let's save as much money as possible in our personal name so we can go and buy that property, get into that first property. That is a key thing, because obviously outsaving the property market typically in most years generally just, is too difficult to do. So the sooner you can get into that, the better. And then once we've got a property and we've got a large mortgage or a commitment, again, might not be able to make the full $30,000 a year, but as Mena says, something is better than nothing. And then hopefully we gradually eat away at those catch-up contributions as well. And again, that can be a good tax-saving measure if you expect your taxable income to rise in future years. And at some point, we want to then have the consistency of making regular contributions. And the whole idea then is to spread your timing risk, because obviously when you make those contributions when those monies will be invested in the share market typically. And if you're young, it should be the share market should be in high growth. And so the benefit of regular investing is dollar cost averaging, is just trying to spread that timing risk. So we're much better off to contribute, $200 a week every week over the course of the year, as opposed to doing $30,000 this year, nothing next year, another 30 grand the year after that, and being very spasmodic. That will work in the longer run, but it's a far safer strategy just to squirrel that money away. And, so it's a bit of a forced savings mechanism as well. But I think the whole point of today's episode is really not to be too super focused, particularly if you haven't yet got that foothold in the property market, and not be too tax focused as well. Again, it's another example of taking a holistic approach. Yes, contributing to super will save tax this year, but it might come at a substantial personal financial position cost, and that's the whole point we're trying to make. Okay, that's enough for today. Until next week, bye for now.